founders. So if all the founders in the room can just very quickly put in the chat window, what's your current stage of fundraise? I'm going to give you 4 options. This is just to get a feel of what's the room like. So you could be fully bootstrapped. You could be a friends and family stage. You could be angels and syndicates, or you could have already hit VC funding or some sort of strategic funding. So just quickly, I'll, on a count of 10, maybe if everyone could just put it in.
Sorry about that.
No worries. All right. Okay, so I'm going to just jump into this. Martha, are you able to see my screen?
I am, but I don't know if you did you change your slide to the next one? I see your opening slide.
Yeah, just 1 second. I'm trying to, give me 1 second.
We'll get there.
Yeah.
Yep.
A quick background on myself. My name is Vishal Chaddha. I've been in the startup ecosystem for over a decade now as an investor, entrepreneur, and venture partner, mostly advising seed stage and early stage tech and tech-enabled startups in the Asia-Pacific region. I have over these, 10 years back, close to 25 early stage startups across different sectors and over the different investment platforms that I've been associated with. A few years back, I co-founded Xelp, which is a technology and data science company, which works closely with startups on MVPs, large corporates and governments on technology-led innovation. We IPO'd the company last year on the Mumbai Stock Exchange, and the stock's not done too bad. So for the shareholders, despite the roller coaster that the markets have been. I'm an Edmund Hillary Fellow, and that's where I met Songi and some of the amazing people at IC. So that's the background to the introduction to IC. And prior to this, prior to 2016, I was a technology CEO in corporate India, one of India's largest news media companies, and did it, over a decade of operating roles in the consumer space in Asia before that. I really think of myself as someone who's from the consumer and consumer tech space. So it's kind of technology and consumer coming together. And then investing has been part of what I've been doing over the last 8 to 10 years now. But I guess more than anything else, what's most satisfying for me, and just as a quick background, would be the time that I'm able to give, on pro bono or otherwise to several governments, accelerators, universities globally to help with their entrepreneurship and startup innovation programs. Okay, enough on me. Just jumping to the presentation today. Martha, can I request you to take on the slideshow? I'm struggling with the page down here.
Okay, hold on a second. I will definitely do that.
So while she does that, quick caveat, I don't have any secret formulas for this session about fundraising, no magic keys. But in the next 30, 35 minutes, what I'm hoping to do is draw on some of my fundraising experience and stuff that I've done with several of the portfolio founders that I work with, from seed to series to impact fundraisers, and really come out with some do's and don'ts that hopefully will help you as you go along on this ride. In terms of logistics for the session, I've kind of broken it up into do's and don'ts, which I'm going to request Martha to help me with. And it's in 10 parts, which should probably take around 20, 25 minutes or so. And I'll go into each one of those one by one. Then hopefully in the next 15 to 20 minutes, towards the end, we can take some of the Q&As. You can also put your questions in the box so we can keep picking them up in the end as well. Okay, so Martha, if you can.
I am. Hold on.
Yeah, so I just thought that before I jump into the 10 parts, this is something that I picked up a couple of years back, and I thought it beautifully sums up the hard climb that funding and building enterprise in general is, right? That timing, perseverance, and 10 years of trying, and this pretty much applies to everyone in the room, regardless of the stage or sector or type of impact that you really are creating. But it is a hard climb, and this sort of sums it up. So with this, I'm going to jump into the first step. So just to slide down, Martha. So the first one is before you start, right? It's important to ask yourself as a founder, why am I trying to raise money? And what ambitions am I really fueling here? Because like it or not, a lot of the narrative on fundraising is actually driven by venture capital money. And if you're competing for that, you need to ask yourself, am I ready for this kind of a ride for building a VC style business? And more importantly, do a reality check. Does my company sort of fit the profile of a VC style business? VCs are driven by large markets and by revenue pools, which can lead to oversized outcomes for them. It's a lot about how their overall fund economics works, right? And not every business fits that model. And many lifestyle businesses, for example, don't fit that model. And then there are impact for profit businesses, right, or not for profit businesses. These are spaces which also attract specialized investors, grant givers, and their approach to investing could be very different from a for-profit VC in some aspects. But make no mistake, they invest for returns too. It's just maybe a different yardstick, a different curve or a portfolio mix, return curve or a portfolio mix, but stakeholders there are demanding as well. So I think the important question to ask is, am I ready for this kind of a ride? But I do want to underscore one key point up front. And, I often tell this to a lot of founders who I meet is some businesses may not be typical venture type, but they could still be perfectly sound, profitable, giving great satisfaction to the founders, and also decent sort of long-term wealth creation along the way. And just because they are small or they are not VC funded, it doesn't make the achievement any less. And I really want to underscore that point about, to the founders in the room. The second one is, when do you raise? Now, there's a popular guy in Valley, John Doerr. I don't know if you guys ever heard of him, but he once famously said that fundraising is a bit like being in, a cocktail party. When the waiter shows up with the snack, you take one. You really don't know when the next one is going to show up. And I think with one caveat or two, this is most likely true. You're not ready for fundraising until you know where you want to stay your company and what do you need to sort of get there. So if you're sort of prepared about that, then you're in the right room, and then you're constantly more or less trying to sort of look at fundraising opportunities. One thing I would want to say here is just be sure that you're raising for the right reasons. And this is an important point. So as an example, if your product market fit is visible, let's say sales are shooting up, then hiring for something like customer service is in my opinion, a great example for right fund usage. But I often see founders who are struggling with PMF, and they're seeing churn as far as their first set of customers are concerned. But they are, they are trying to raise money to push sales, for example. Now that, in my view, is pretty bad usage of money that's being raised. Martha, if you can go to the next slide. Then is the third one, which often is a big debate in terms of how much should I be raising. Once you've sort of decided about fundraising and taking your startup to the next level, my general advice here is you should raise enough to support the, sorry, I'm getting some background here. To support for the next 18 to 24 months of your planning. Usually this is the kind of time which a company would need to show any major change, significant change in business metrics. It's ideal not to try and raise too much or too less, as both experiences could be troublesome. You raise too much. One is you end up diluting yourself. But more importantly, when you are in excess liquidity as a company, best of the founders, and this applies to pretty much everyone, can lean towards irrational spending and take wrong decisions leading to false positives. I mean, classical example being going for aggressive paid customer acquisition, which can be a huge false positive for any business. On the contrary, if you raise too little, or let's say you raise too late, you could be running into trouble as well, right? Because you can run out of runway, you can get cramped to execute your plans, and VCs can smell desperation from really far, right? So you don't want to be in that position as well. And also remember, you should factor in the time taken to raise. It usually takes approximately 6 months to bring the money into the bank, if all goes well. And this is my experience over multiple raises, right? So effectively, your fundraising efforts need to kick in at least 9 months prior to you running out of cash in the bank. That is to ensure you comfortably get there. And if you do the math, you'll realize that if you've raised 2 years of cash, and I'm asking you to start planning a year before your next raise, there's pretty much little window that you're not raising in, right? And that's entrepreneurship. You're literally on the go all the time, right? The fourth one is around dilution dilemma. Right? This is a big question which keeps up coming all the time. How much should I be diluting myself? Now here I often see, founders making one small mistake, which is trying to overvalue their company in their fundraising efforts, right? There's a big temptation to go for high multiples to revenue, high multiples to EBITDA, high multiples to GMV. These are badge values these days, but honestly, not much beyond that. Getting above normal outcomes, it doesn't serve the purpose in the long run. That's been my experience. The math almost always catches up with you. It gets harder in subsequent rounds to show progress. And, justifying those valuation and valuation multiples ongoing is just very, very hard, right? So it's, at best, I think, the word ephemeral euphoria, right? You just get that little high one time. So it's best to keep your goal simple. I think you should raise enough and raise it at fair valuations. The worst outcome is you raise less money and do it at very aggressive valuations, right? In that situation, you don't have enough money to execute all your plans, and you're justifying the next valuation becomes super hard. So it's a pretty significant trap which you should try and avoid. Martha, we can go to the next one. This, I think, a lot of people in the room would probably be familiar with. Who are the types of investors? You would probably know this by now, but if you're an early stage looking to raise, very early in your company, then just say to build an MVP or prototype, then your own funds, friends and family is a very popular place to start. Only caveat here would be just never get into a valuation discussion at this stage. I sometimes see founders do that. It's too early in the life of the company to arrive at any sort of valuation when you're at that stage. Also, remember the other party is probably not equipped to negotiate with you. A, lack of knowledge about investing. B, they have vested interest, right? They are friends or family. So be nice. It's not the stage where you should be doing any sort of valuation. Convertibles, safe instruments, depending on the country that you live in, these are good options to go with. The other mistake I see founders make is they often, in trying to get money early, and they get too many people on the cap table. This can really complicate your life when you go to subsequent rounds. If you're looking to raise bigger than what friends and family can do, then angel networks, syndicates, crowdsourcing sources, these are very good options to explore. But with these options, also be very mindful not to get dragged into too many people, or with angels specifically, and I've been an angel, so don't hold me to this, but don't get dragged into lengthy conversations for tiny checks. Angels are notorious for that. So you have to be able to see where there is a maybe or a no coming and be able to spot that. Also, with angels and syndicates, never go for someone or a group that you haven't been able to reference check properly. Good quality angel is any day better than the check size, any day, eyes closed. And smart angels can actually be great investors and bring a lot of value as you start going into the sort of next stage of your company. So be very, very careful about who you pick as an angel. Okay, so you've hustled your way through the first year of your company. You used your seed money to build an MVP. It's kind of fallen in place. Product validation is looking good. Early customers have started coming in. Now the business needs money to scale. It's time to move to the big game, really, in that sense, right? And this is the institutional VCs and the funds with all the protocols and everything. This is where it starts getting a bit confusing, at times intimidating as well. I can tell you from my India example, which is a market I know closely, there are close to 200 funds, which are, more than 200 funds, which are active at any given point of time. And all of them have a sector, a stage, a ticket size, geography, and not done the right way, you can end up wasting a lot of time and not getting anywhere in this maze. And this is where I urge founders to do two things. One is always follow a process. And two is seek help from advisors. By process, I mean start by being super disciplined in doing your homework to shortlist your funds and see where are you ticking the box in terms of the larger fund objectives and what your company is trying to do. Have your databasing skills handy for this one. Excel, Google Sheets, Notion, whatever works for you. Then when you find the right fit, there could be a couple of funds, you need to go deeper. You need to read the fund's website. Normally, those are great places to start. From there, you'll be able to find out things like who are the general partners who are dealing with your sector, your stage, your geography. Do research on them, and their investment approach. From basic internet search will tell you. Follow them on LinkedIn, for example, to see what they are writing about, what are their views. It really is handy when you start getting into conversations. The next bit is trying to get introductions to them. Usually warm introductions through your own networks is absolutely the best. Going through one of their portfolio companies is almost 100 on 100. So those are the two things you should be trying. Cold emailing is not bad. It's also fine, but the golden rule there is keep it crisp. So many founders mess up on this. I get 8 to 10 emails a day. And remember, the idea is to get a meeting and not to tell everything about your company in just that one email, your backstory and all that stuff which people put in there. It's also not wise to not say anything, like keep an email which says, I'm just seeking a meeting for this, absolutely fabulous idea. So say enough to just get your first sort of 15-minute call, and I think that's a good start to make. Martha, if we can go to the next slide. Okay, the pitching. So you've done the hard work, you've landed up with a meeting with the right investor. I know there was a session just before this on pitching, but just my 2 bits on this. This is both an art and a science, right? Pitching, we heard yesterday also there was a session. Pitching is so much about storytelling. And this is one skill you can never have enough of. I keep pushing founders all the time to keep building on this. The art of communicating effectively. It comes handy throughout the stages of your company. You could be talking to investors, you could be talking to early customers, you could be talking to external stakeholders, early employees. So just keep investing in it all the time. In terms of the pitch specifically, I think one golden rule as far as I'm concerned is you should absolutely be able to say in flat 30 seconds what you do as a company. I oftentimes see founders fumble with that. That is something which you should try and perfect. Just make a template of 30 seconds. There are times so much passion and emotion is involved that you end up sort of confusing the other person. So remember to do this well. Keep the jargon out. Don't throw in too many metrics, etc. at this stage. In terms of the actual pitch, I know Emma has covered it in a lot of detail in the previous session, which some of you might have attended. But very quickly, from an investor lens perspective, there are many formats which are around, but barring some outlying sectors, something like biotech or some advanced tech, most B2B and B2C businesses will be very happily explained in this 8 to 10 slider over a 20-minute conversation. And you can just run through these points on your screen right now. What problem are you solving? What's the unique insight that you bring to the table? How are you different from competition? Market size, very important to just kind of give people a sense that how big can this whole thing be? Who's on your team? Super important. What's your product currently looking like? Your go-to-market strategy. You keep hearing this word, unit economics. How are you going to make money? Financials, however you want to put it. What do you need the money for? Like, have you really thought through the plan that you're going to be working on? And lastly, if you can, what is 3 to 5 years roadmap and success looking like? Like, if we ride with you and we all get to 3 years, 5 years from now, how's this whole thing going to look like, right? So these are typically the 9 to 10 slides that you should try and focus a lot on. If you're a technology company, one thing which is absolutely gold standard is your product demo. I'm a big believer in it. It's just totally worth showing the earnestness and focus on building something out and action bias. And honestly, it doesn't matter if it's clunky or if it's bad. Most MVPs, you'll realize, are not even remotely close to the final products that companies come out with. You go and pick any example, it's nothing close. So don't be ashamed of it. Put out something in the open. It'll always help you. Since a lot of us in the room are on impact ventures, I think a quick word here. You could be for-profit, you could be not-for-profit. There are some nuances in the pitch which could look a bit different. For example, I think it's important to establish your purpose, like how you're going to protect this organization in the long run from not swaying too much towards profit. Songi spoke yesterday about the balance between profit and objective. For example, your purpose could be to reduce poverty in communities, right? By giving, say, clean drinking water. And the core activity could be, you could be selling or you could be distributing low-cost water treatment products. Then there are outcomes, which are there in regular businesses also, but often, and yesterday I was in this home group with my small team, and one of the founders from Bangladesh said that, how do I measure my outcomes properly? And this is where it's very important to establish that as a company, as a founder, you are in a position to measure. So in my example, reduced illness within the community due to waterborne diseases could be one measure of an outcome. And then, there's something called output, right? Which here would be reduced time that people are away from work. So you are able to reduce sickness, and then people are at work more hours, the cohort that you're working with. And I think this is the point till which the impact venture is directly accountable for and should be able to demonstrate metric tracking. But above everything else, and this is again a point to underscore, at early stage companies, and remember we're talking a lot about early stage here, it is mostly about the founding team. People are mostly investing behind the grit, the vision, the execution capability of the founders. The solution comes next, the product. Most other things, and I can say this for most other things, can be made up along the way if we have a bunch of good founders, right? So this is broadly my view of the whole thing. Martha, if you can click to the next slide. Okay, the logistics of fundraising. Very simple points here. Try and run most of your discussions, if possible, as parallelly, as swiftly as possible. Think of it a bit like a dash, not a marathon, because you don't want to be an investment opportunity which is just kind of available there all the time in the market. Every fund is got your business plan in their stack. This is easier said than done. Mostly you'll be depending on funds for the meetings, but you can do your best to hustle and try and do it as fast enough. Also, because pitching can be very physically and emotionally draining, and I know a lot of you in the room would have gone through those hoops. So it's best to do it fast, right? Also, scarcity helps with some caveats, right? It's a small ecosystem, whichever country you're working in, or if it's Asia that you're operating in. So don't try bluffing. Be honest. If you have funds chasing you, if you have other investment sources chasing you, it's good leverage in a discussion and you should sort of use it. But don't bluff your way, because it's a small ecosystem and sort of people talk to each other, and that's very bad news for you then. Last one on logistics would be, I often see founders getting off track by this metric called number of meetings. Like they're super busy, and whenever you meet them, they're sort of saying, I have so many meetings going on. But well, that's all good, but the key is, are they moving in the right direction? Because as I said earlier, VCs and funds are famously poor at saying no. So as a founder, you have to be able to spot a maybe because, or a no, because those can be very dangerous. They can really take up a lot of your time. Once you find an investor, this is where the business end of deal making sort of starts, right? This is where the serious stuff starts. The terms established in your earlier funding rounds are very, very hard to let go of. So which is why it's very important that whenever you do any sort of structuring, you have to build simple vanilla structures initially. So to underscore a point I made earlier, always stick to stuff like convertibles in friends and family and angels, because those contracts are much simpler and they don't complicate your future equity rounds. Which with institutional investors, in terms of deal structure, I think the only piece is be very, very careful about the fine print, right? There are and there can be potential minefields which get bunged into term sheets all the time. Look out for stuff like liquidity preference. Look out for stuff like voting rights, which founders can really overlook at the early stages. I've had a founder recently who had a great outcome in terms of exit, but couldn't really do anything significant in terms of wealth creation for himself or his early team. This was because of liquidity preference. There was a 2x clause which he had committed to sort of unknowingly. Voting rights is also a tricky one. Badly negotiated, it can lead to key decisions moving away from the management to the board and to shareholders, and that is also very inefficient for any company. You want to have flexibility as management to be able to run day-to-day operations. What's worse in all of this is subsequent investors almost always will demand these. So it keeps getting more and more complicated. It keeps getting knotted all the time. There's another thing you'll be doing at early institutional raise time is the board construct. And how you make the most of it is a very, very important decision for any founder. Great boards can be a huge asset. And lousy boards can actually sink a company. A good startup can actually sink. But I think this is a separate discussion altogether, so I won't go too much into it. Last bit here would be, remember that negotiation is actually towards a goal, which is fundraising. The negotiation by itself is not the goal. We are all alpha people in this room. We are achievers. We've gone out to set our own startup. And sometimes we get too sort of sucked into the whole negotiation process. You should know what to let go. Idea is always to get a good deal, which kind of both sides are happy with. And you want to bring in a partner who will, sort of truly bring more to the equation than just the capital, right? So that's an important point to take care of. And in terms of wrapping up your whole sort of deal process, there are important milestones in the deal closing journey, and there'll be various aha moments which will come. Some of it can relax you. There's this famous term sheet milestone which comes up. Some of you who've gone through it will know what I'm saying. From term sheet to closing are multiple loops again, diligences, SHAs, SSAs, which take a lot of time, which take a lot of effort, which take a lot of discipline to close. There can be many a slip between cup and a lip there. So you want to avoid all of those. So in this phase, which is once you've done your term sheet, until you've got the money in the bank. You have to be super process oriented, obsessive about follow-up with lawyers, with accountants, with company secretaries, and with the investor side to ensure that the closing doesn't slip, because this can just get dragged for all the wrong reasons, right? Martha, if you can click to the next slide. The big question, what if my funding doesn't happen? Look, less than 1% startups reach institutional funding, and that's a reality. And if you are unlucky to not reach there, it is not the end of the world. I often say this, never take that rejection sort of personally, because there are so many factors that feed into the decision and not everything is in your control. You could be in a tough liquidity cycle when funding is not easy to come by. Like right now, right? We've entered one of those winters where, liquidity is going to be tight for some time. So smart founders will always pivot in these instances, find ways to sort of extend their runway. And, as and when situation improves, they would be alive and kicking and prime prospects for investors to sort of come into the company. I also would urge all founders, especially in the impact space, to look outside of classical VC money. So look at your government schemes, look at debt. A lot of governments are pushing banks to do stuff for startups. I know at least in India that's happening, but I'm sure pretty much the same story in other countries. These are obvious, but sometimes we tend to miss it, right? Just as a, sort of closing up, it is a time-consuming and emotionally draining process, and it's not done till it's done, right? So you have to be mentally prepared for the ride. You have to enjoy it, and if you do all of it, you will excel in it. There are really no shortcuts, but you can make the most of it. And Martha, if you click to the last slide, it sort of sums it, for me at least, that if you chase the vision and not the money should sort of end up following you. So this is what I had to share over 10 steps in terms of what my experience has been in the last 8 to 10 years. I think I should stop at this stage. We're at 40-minute mark, Martha. So try and get to 10 minutes of Q&A if that works.
Yeah, that would be awesome. I'm pretty booked, especially for the participants. So before we open the stage, we had actually one question here in the chat, which was, what should you do when you already have too many people on the cap table?
What should you do? Well, one of the ways is to try and see if you can exit some of those people in the subsequent round. It's not always easy. You might have to do something which is a secondary, which is at a discount to the primary which is coming in. That's one way of doing. The other way, which is slightly complicated, but I've seen some founders try to do it, is to bunch up the early angels into one entity and sort of redo it. But again, that's not a simple process. It takes a lot of alignment. But as I said, the best is to sort of be very, very careful about this early on.
Awesome. So
Sharif's, that's the suggestion I was also giving, what Sharif gave. Yeah.
Awesome. Well, does anybody want to ask the question in person? Or there's another one here in the chat, which is regarding the deck. What if your business model is complex and has multiple channels, verticals?
Can you repeat that?
Regarding the deck, I assume that means the pitch deck. What to do if your business model is complex and has multiple channels and verticals?
Well, if the business model is complex, you should still try and make sure that the headline is something you can describe in a minute, because anything which is more complicated than that needs to be sort of simplified before you put it out, because most likely you're trying to do too many things. And as an early stage founder, it's super important to keep it simple. You want to be the best in one or two things rather than trying to do too many things and be an also ran. So I would really urge you to sort of keep simplifying it. In terms of the bigger pitch deck, I think Ahmed's session was very useful and there are lots of tools. So try and see how use visuals and a lot of other stuff to communicate strongly without ending up confusing the audience.
Well, yeah, and by the way, all the materials will be shared. We'll go first, Matt, then the question from Amy in the chat, and then Sharif. So Matt, if you want to ask your question.
Yep. Hi. Thanks, Marta. Is my audio okay?
Yep.
Hi, Vishal. Thank you for the presentation. It was excellently detailed and very, very clear. Regarding your point about failing fast, I would just like to clarify that a little bit because I think that's a really good point. There's no point in dragging out negotiations that long if it's going to end up negatively. Do you have any suggestions of how to lay that on investors without kind of upsetting them of us trying to rush the process? Because so we get the feeling sometimes when we negotiate that they want to take their time. But then again, sometimes it's a luxury that we can't afford, especially during this time of the health crisis and all. So do you have any tips on laying down on investors quite subtly, but yet then again, not offensive?
Yeah, so, you should be able to pick up cues if you're running the process tightly. There are verbal cues that you should be able to pick up. And then if you're in the process, for example, one great way to know if you're past your term sheet stage and your process is dragging is when you set up something like a data room and you give access to investors. It's very easy to see if investors are spending time on a particular part of the company. It's very easy to figure out if there is certain documents which are being accessed more frequently. So that's one cue I would pick up. But I think the bigger point here would be to almost always be very straightforward about this and check with them if they are interested. More often than not, if you are honest in that question and straightforward, I don't think people will get offended by that. It's their job. They do it every day. You might feel it this way because this is probably the investors that you're talking to. But the other person does it for a living and does it every day. So just do not feel sort of coy about it at all.
Thank you very much. Very, very good comments. Thanks,
Okay, no problem. We had a question from Amy, which is kind of a very long question, so I don't know how fast you can explain it. There's whole university courses about it, let me put it that way. Can you please explain the valuation process? What information is usually needed for valuation? After Amy, we have Sharif and then Venki.
Wow, that's actually a long process. So it depends a lot on stage of the company, sector of the company, how the revenue pool that company is part of, how is that expected to move forward. So it's super hard to generalize a valuation process. There are tons of models flowing around from discounted cash flow to all sorts of other things if you're a later stage company. But as I said, if you're very, very early stage, there is really no concept of trying to arrive at a valuation if your first sort of revenue has just started trickling in. If you are pre-series A or series A, then famously your ARRs, which is your annual revenue run rates, they are important. if you are EBITDA positive and you've started showing some signs of sort of stability in terms of your EBITDA, and if you are like a brick and mortar business, which is going to be on a predictable growth curve from there, then EBITDA start becoming important. If you are a transaction business where you are sort of aggregator and GMVs are flowing through, then GMVs are also something that investors use. But I think it's a combination of a lot of things which is typically used to arrive, and you usually would get a band. And this is where, if you refer back to the point I made in the presentation, if you are sort of in the band, you will know it, right? So don't try and, overachieve that band, because eventually this all sort of evens out, right? The valuation is not the goal in itself. The goal is to create a successful venture, right? So that would be one perspective to keep in mind.
Awesome. Thank you so much, Vishal. I know it's hard to explain that because, like I said, it's a whole university course all by itself. But we'll have, like I said, Vishal is an expert, and if you want to hear more, we can organize a separate workshop about that later down the line. So don't be too stressed about that. The next person with a question was Sharif. Go.
Sure. Thanks again, Vishal, for the very insightful session. So this question is basically I'm asking on behalf of everyone else as well. Most of us might be in the earlier stage of fundraise, and I guess when you get out the gates from pre-seed, seed, and you're about to raise from early stage institutional investors, you're going to run into this issue of like investors co-investing. And so what do we look out for maybe, 2-3 funds that may co-invest in your round? Usually there's a term called the lead investor, and then there's someone who's comfortable in following on, or rather to follow the round. How best to go about negotiating around that? Just to give you a bit more context, for example, let's say a fund may have a mandate of typically investing in an early stage and taking up as a guideline about 10% of that particular entity, right? And then let's say you're raising a $500,000 round, perhaps on a note or a safe, so maybe valuation is not an issue. Obviously, you'll kick that down further down the road. And a fund has a mandate to invest like $500,000 in that round, and they wish to de-risk that round by co-investing with someone else. How would you suggest managing that co-investment situation between two funds and nudging who might take the lead and who might follow in that sense?
Yeah, sure. So good you brought that up, Shiv. So that happens quite often, and they'll usually timing this is going to be hard because all funds are sort of moving in different momentum. But once you've spotted the fund, as you rightly said, you will be able to know their sweet spot. You will be able to know, let's say you're trying to raise $1 million and the fund says that our investment mandate allows $500,000. That is your cue to say that these guys, they are first to the door and their ticket size is kind of looking there. You pretty much start structuring your term sheet and deal construct with them. And to the other people, you let the word out that we already have someone who's looking to be taking half the round and looking to be the lead investor. You will immediately get a response as to whether those people are happy with that situation, as in they are happy taking, say, a quarter of the round. Are they happy sort of following on with the lead investor, or is that against their investment mandate? So as I said to the previous question as well, just being super diligent and honest and straightforward with this communication is useful, because at that stage, then it's visibility to everyone in terms of what's the track we are running on and who are the people who we are running on with. If possible, time the term sheets, because a same term sheet is so much more easier to translate into your common SHAs and SSAs. I've had 1 or 2 complications where that couldn't happen. and then trying to bring them into a common document was a challenge. So that would be my general guidance on this one. I hope that answers your question.
Sure, thanks.
Awesome. Thank you so much. The next in line was Venki. Please ask away.
Okay, great. So, hey, Vishal, great presentation. Thank you so much. Just one question that I had is, we are a deep tech company, we're a 5G company, and we have some deep IPs and first in the world as well to implement. When is the right time to get our IPs evaluated?
Oh, so did you say when is the right time to get your IPs validated or valued?
No, I'm talking about valuation of IPs.
Valuation of
Kind
IPs.
of get a.
Look, so if your question is around when should I be doing fundraising, I'm a deep tech company. Honestly, it is a function of your current liquidity and how much is the kind of money you need to continue working on your plans. If you remember, I said that I always sort of recommend having a visibility of the next 18 to 24 months of funds. If you have your product roadmap handy and you know that this is the kind of engineering support that's going to go in, and if you don't have that money in the bank, then probably now is the right time to start going around and checking on who could be interested. But in deep tech companies, one big factor.
Yeah, Vishal, the point is, we are in the midst of pre-series A. We have enough money for.
Sorry, you have enough funds?
We lost you.
Yeah, so sorry,
Okay.
the question was, how important is it for us to get our IPs evaluated before we go in for a Series A? Or do we need to do it maybe, at that time? Do we need to do it now? Because, spending money on valuating your
is expensive.
IPs is a lot of money.
Yeah, well, there is no right answer, Venki, to this one. Honestly,
money.
yeah,
Very
I know
expensive. So
I know what you're saying. I know what you're saying. So there is no right answer. You could you could sort of delay it, but getting your IPs valued is always a good thing to do. And if you don't have the money, then I would be putting that as one of the fundraising objectives to the next round, which is coming in, and I would do it fast, right? Because you don't want to invest too much time of you and the company trying to build on something which could potentially conflict later. So this is one way. Some investors might have an issue because they'll be coming in a bit dark and cold into this, not knowing whether the IPs are protected. But I think those are the conversations which will be around valuation and what terms they sort of come in. But not an easy answer to that one, Venki, unfortunately.
I mean, an open question. So last but not least, Amit, where are you? Please unmute yourself and ask your question.
Hi Vishal, this is Amit here. I hope you can hear me.
Yes, Amit, I can hear you.
All right. So what I'd like to know is there sort of a golden time at which to do a raise? In other words, in the life cycle of a startup, is there a point at which it's just too late to go out and ask for money? Will investors view you with skepticism if you've been around for a while, if you're doing stuff, and they come back and say, hey, you didn't have early traction or whatever, any number of reasons. Why didn't you raise money till now? Can somebody go out and raise money in year 2, year 3, still say, hey, we are a startup, we were bootstrapping, we were testing the market? Any views on this sort of non-science part?
Yeah, that's a good question. Look, my general view, Amit, would be, as I said, people are investing behind teams. And if you are a startup which has been hustling hard enough, which has been giving 24/7 to the idea, then you would have that kind of output to show in the first 12 to 18 months of hustle. So oftentimes, if you are showing up 3 years into your journey or 5 years into your journey with a product which is still sort of pivoting, which is still not got the MVP, then there are two things which start happening there. One is you're telling the fund, the investors, that we are probably not sort of 100% into this because we haven't got the output that we should be able to demonstrate, which is not great. Second is the idea itself might not be as powerful, right? Because if a bunch of great people are attacking a solid problem with a good idea and giving all that they have for 18 months, it's very hard to not have an interesting discussion with an incoming fund. So these are the two situations which can cause this to be a 3-year or a 5-year conversation. You should try and avoid that. So golden period is the first sort of 18 months to 3 years of your company where all of this should be coming to fore.
Awesome. Thank you, Vishal. Sharif, is your question short? I'm asking because we
it will be a short one. So it's actually a follow-up to the earlier question and a bit of a scenario. So there's always a saying, raise as much as you can, right? To that point, if say you approach a fund and then they say their mandate is, let's just put a hypothetical number, $1, right? $1 million, and you're raising like $500,000, 500,000. And they say their mandate is $1. So to that scenario earlier, should you then say, okay, you know what? Let's do a seed round of $1 million rather than $500,000. Should you optimize for the mandate of the fund, or should you then go to the fund and say, hey, you know what? I know your mandate is $1, but instead, I'm still insisting on raising $500,000 right now for whatever reason. How would you? What's your take on that? Again, to optimize for the fund mandate, or to and raise more, or raise a smaller round versus your original plan?
Yeah, so Sharif, it will be situational. If you have a lot of options flying around you, if you are in demand, you would sort of take the aggressive posture with the fund. And as I said, never over raise, because that will mean a lot of trouble for you in terms of dilution and over sort of capitalization of the company. But if you've been at the fundraising doorstep for 5-6 months, and conversations are hard to come by, it's a liquidity crunch, and this is pretty much the only fund that is interested in you, then you will sort of sit them down. Most funds realize that diluting the founders too much is also not a smart idea, right? They don't want to take over position, and you know it well given your background. So somewhere, hopefully, the fund and you will find a mid path in terms of the raise. And I think that's a happy solution in that scenario. Yeah.
I think that answers your question, Sharif. Awesome. Well, everyone, we're taking the next hour off here. Please go